China's economy is showing clear signs of slowing down, caught in the crossfire of Donald Trump's trade war and mounting domestic challenges. Factory production and consumer spending have both increased at their slowest rates in nearly a year, signaling deeper issues beneath the surface. But here's where it gets controversial. While some experts argue for urgent government intervention, others believe the situation doesn't yet warrant drastic stimulus measures. The latest economic figures have intensified pressure on Beijing to introduce more stimulus policies to prevent a sharp downturn. The country's once thriving property market is now grappling with a serious. This is the slowest growth since August 2024 and falls short of July's 5.7% increase. Retail sales, which serve as a key indicator of consumer spending, expanded by only 3.4%, the weakest pace since November 2024 and down from 3.7% the previous month. These numbers suggest a clear loss of economic momentum. Zichun Huang, a China economist at Capital Economics, pointed out that while some of the slowdown can be attributed to temporary factors like extreme weather, such as the hottest temperatures since 1961 and the longest rainy season in decades, the underlying trend is a genuine deceleration. This puts added pressure on policymakers to consider additional support measures to stabilize growth. Factories have been particularly affected by these harsh weather conditions, which disrupted production schedules. Meanwhile, the government is encouraging manufacturers to explore new markets to compensate for the unpredictable tariffs imposed by the Trump administration. Some success has been reported in redirecting shipments originally destined for the U.S. to regions like Southeast Asia, Africa, and Latin America. However, the ongoing property crisis continues to weigh heavily on the economy. Lin Song, chief economist for Greater China at ING, believes the weak data signals a need for more stimulus to ensure a strong finish to the year. She noted that although it's still early to assess the impact of consumer loan subsidies introduced in September, broader economic weakness suggests further policy support is likely necessary. Song also highlighted a high possibility of additional interest rate cuts in the near future. On the other hand, Zhao Pengxing, senior China strategist at ANZ, offered a more cautious view. He acknowledged the slowdown but argued it isn't severe enough yet to justify a new round of stimulus. Sheng pointed out that recent government actions to curb aggressive price cutting by companies may have made domestic demand appear weaker than it truly is. He also expects that policies aimed at boosting service consumption will help offset some of the demand shortfall this month. Chinese households are feeling the pinch as their wealth diminishes amid the real estate downturn. This has led to more cautious spending habits, compounded by declining business confidence and a fragile job market. Unemployment edged up to 5.3% in August, the highest in 6 months, rising from 5.2% in July and 5% in June. Adding to the concerns, new home prices fell by -3% in August compared to July, and were down 2.5% year-on-year, according to another dataset from the National Bureau of Statistics. This ongoing decline in property values underscores the challenges facing one of China's key economic sectors. So, what does this all mean for China's economic future? Should Beijing act swiftly with more stimulus, or is patience the better strategy? And how much of this slowdown is truly structural versus temporary? These questions are far from settled, and they invite a lively debate. What's your take? Do you agree that more government intervention is necessary, or do you think the economy will stabilize on its own? Share your thoughts below. This is a conversation worth having.